good morning. So we'll continue from where we
Mhm.
stopped the last time.
Okay.
And that was we are going to be starting from evaluating the achievement of corporate financial objectives. So we're just looking at, we've been talking about financial objective. If the last class we talked about if a company does not have a financial objective, they will have a financial constraint. We also
Mm.
looked at how agency theory comes in, protecting the interest of all stakeholders. And they made us realize that you cannot satisfy all stakeholders, right? And that is
Mm.
why we have agency conflict, especially between um, the shareholders and the managers, because managers are after their own interest, while the shareholders want to maximize profit. And we looked at the different ways in which it happens, where we're talking about time horizon, moral hazard. Can you give me one?
We have time origin, moral hazard. I think the type of industry, something like that.
Mm,
Abi?
no. Okay, so I think there are five of them. Let me just go back. So risk
Oh,
aversion, earnings retention, effort level. So those are the types of the way agency conflicts can arise. So
okay.
then we talked about the agency cost. If we want to prevent all of this, how do we manage it? That was where we talked. There are just three. Cost of monitoring. That's when you prepare your audited financial statements. You ensure that accounts have been prepared. Opportunity cost. We talked about bonding costs. So, and we also talked about different ways in which they can reduce, agency problem by having a board of director, having non-executive directors that are not into day-to-day activities of the company, and they are sure that they will act in the best interest of the company. We talked
Okay.
about having a remuneration package that will be so attractive to senior managers so that they can act in the best interest of the shareholders. Then we talked about share awards, share options, giving them shares in the company so they feel like they are also owners of the company. That way they are able to act in the best interest of the what of the shareholders.
Okay.
Then we talked about corporate governance. We looked at the elements. We look at the steps that can be taken by corporate governance to reduce agency problem. Talk about the responsibility of the board, the composition of the board. We talked about having independent non-executive director. We talked about board committee, where they talked about the audit committee, nomination committee, and remuneration committee. So then we talked about the external auditors too. These guys should be reporting to the audit committee and all of that. Then we looked at stock exchange listing rules
Hmm.
that they can also help to protect the interest of the shareholders with all the reports they ask for. They ask for financial statements, quarterly and annual reports, and all these reports, if they don't submit, if the company does not submit at the time frame given, they can face what penalties. Then now today we'll be looking at how to evaluate. I don't know if we talked about that. One of the problem of, even, yeah, I remember the first part where we talked about one of the problem of financial management or measurement of if financial objective has been achieved is this evaluation, because like it's difficult to know if shareholders' wealth has been maximized. It could be difficult to know. They said profit maximization is easier to know. So they gave, I think it was about four of them, the ways in which the financial objective of the company can be achieved. So that's where they talked about. Do you remember what I'm saying?
Yeah.
Okay. So that's where they talked about all these objectives, and it might be, I think the only one that is easy to get is EPS growth and profit maximization. So we're going to be looking at how to actually calculate all of this, right? So let's start what we have come here to do. Okay, so evaluating the achievement of corporate financial objective. How do we evaluate it? So when a financial objective has been established, actual performance should be measured against the objective. And this requires the calculation of one or more suitable performance measurements. Financial objectives are commonly measured using ratio analysis, and financial ratios can be used to make comparison. This might be comparison over a number of years. That's why we talk about trend analysis. We talk about what has been the trend over the period of time, so that we can compare this period with that period and see what we are doing that is not okay, or what we need to fix, or what we need to improve on. Then comparison with similar ratios like of other companies. I can compare my performance with what a competitor is also performing, and comparison with industry average. There are some industry that has like, so for some of their ratios they have like an average that it should not exceed, or it can exceed, or should not go beyond, should not go under. So you want to compare your performance with the industry average. So the very first one we have here is return on capital employed. Return on capital employed. And how does this work? um so formula for return on capital employed. So let me just write the topic, so can just evaluating. Sorry, oh, this is not even the beginning. Okay. Great. Okay, so very first one is return on capital employed, ROCE. And okay, I think I should write it in full. Just copy, 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 copy. Okay, so profit making company should try to make a profit that is large enough in relation to the amount of money or capital invested in the business. The most important profitability ratio is what? Return on capital employed. And this is the formula. We have profit before interest and tax divided by share capital plus reserve plus long-term debt plus preference share capital times 100%. So you might be required to calculate this for a company. So this is the formula: profit before interest and tax divided by share capital plus reserve plus long-term debt plus preference share capital. So something I would just like to call your attention is that not all long-term liabilities goes to the calculation of return on capital employed. So that's the mistake most people make. They'll just, since it's share capital plus reserve, that means you are taking everything under your equity, and long-term, your reserve is your retained earnings. Long-term debt plus preference share capital, they'll just assume that it's everything under your, so it should ideally be everything under your non-current liabilities. Every debt, every liability that is going to take a while to pay them off. But you have to be careful when answering the question, so you don't also pick what is not supposed to be there as the denominator. So There's an example. Do you want to read for us?
Okay. Um, Example: return on capital employed. ABC company achieved the following results in year 20x5. So we have January 20x5, 31st December 20x5. So the first thing there is share capital of 1 naira. For January, we have 1 million, and for December, we have 1 million as well. Share premium, we have 500,000 for January, 500,000 for December. Then for accumulated profits, we have 2.5 million for January, 3 million for December. Then for bank loans, we have 1 million for January, 2.5 for December. Total,
So just let's just say that all figures are assumed to be correct. So let's go to the additional information.
additional information.
Yeah. Interest charges.
Uh, Interest charges on bank loans were 150,000. Sales during the year were 29 million. Yeah, 29
29.
million.
Yeah.
And dividend payments to shareholders were 225,000 required. Calculate the return on capital employed for year 20x5.
So we've already said our capital employed is return on capital employed is profit before interest. Sorry, profit before interest and tax divided by. I thought you'd have known by now. share capital, share capital plus reserve plus
Um,
long term
um,
debt plus preference. What do we call it now? Preference share capital. Is it capital or dividend? Preference share capital, yeah. Preference share capital, everything times 100 over 1. So let me just do this. Um okay. So our profit before interest and tax is what in this question? So let's check. See, profit before tax. So you are going to do what? You are going to add back your interest. So this profit before tax, is it the okay, let me just even ask you. Is that the figure we are going to use? No.
Profit, no.
So the question is the parameter is profit before interest
That's
and tax. So that means you are going to add back your interest. So to get
interest.
profit before interest and tax, we were giving profit before tax. So we have profit before tax plus interest. Then we'll have our what? Profit before interest and
The
tax.
times,
So we
yes.
have sorry, just be using this, or let me just copy one of their naira here. Maybe translate. Sorry, don't mind me. That's how I used to do. Let me just see if I can copy. If I can't copy, we'll just continue using what we have, Jared.
Mm-hmm.
Don't let me use this one to waste our time. Okay, so profit before interest and tax. So we have 150,000. Oh, sorry. We have 1050 1050 123. Then we have our interest to be 150,000. Hope you have your calculator, so you can also be.
Let me before we move up. Don't mind me. I've not even bring it out, so it's in one of those bags in the
Okay. So let me
Let
just.
me not bring it.
So we have what?
Hi.
Um, we have 1.2 million as our profit before interest and tax. So mm, okay. So we've gotten our profit before interest and tax. Now let's work on the denominator. Um, calculate the return on capital for the year 2025. Okay. So our share capital is what? Our share capital is so share capital is 1 million. So our share capital is 1 million. Our reserve. So they used to do something, but return on capital employed is also profit before interest and tax divided by capital employed, if given straight up.
Sorry, I didn't. Let me say
So I'm
the.
saying that our return on capital employed can also be
Mm,
profit before interest and tax divided by capital employed. All these guys you see here is also capital employed. So, like the
mm,
addition of everything is called capital employed. So, what do I want
okay.
to say? So, some questions they might give you. I doubt, Sha, but if they give you like the capital employed straight up, then you don't need to be doing share capital plus reserve plus all of that. And
Mm,
sometimes the question will tell you if they want you to use average capital employed or total capital employed. So if the question is silent, most times I think you just so the secret is just to state your parameters. If you are using average capital employed, let us know. If you are using this formula as stated, let us know. Don't just assume
mm,
that the so it's always good to just state your formula, whatever you are using.
mm,
So
mm,
the fact that somebody got 50,000 or another figure different from yours does not mean that you are wrong. You guys could be right. So it's just stating your assumptions in this anything financial management, you need to state your assumption. State
mm,
whatever is guiding your thinking there, so that when the examiner is marking, if he has a different answer, we know that you also know what you are doing. You understand? So
mm,
reserve. What's reserve? Reserve is accumulated profit. Is also your retained earnings. So we have 3 million. I'm sorry, I need to do something. So we have 3 million. Then we have our long-term debt. Um, mhm. Our long-term debt. So this question now they didn't classify as such whether it is whether it's a long-term liability or is they just wrote bank loan. So you need to use our discretion. For this question, we don't need to stress ourselves because we've already been given the details. But now the question is, am I using closing capital employed or opening capital employed, or you are using average capital employed? So you have three aspects. If I'm to use opening capital employed, which is not advisable, so I'll just advise you use either the closing capital employed or the average capital employed. So if I want to use using you have that's why you have to always state your assumption. So if I say using closing capital employed, my ROCE will be what? ROCE equal to ROCE is equal to
mm.
profit before interest and tax is okay.
Let's
Let me
see.
write it
Yeah.
out. 1.2 1200123. Then our closing capital employed is 7 million.
7 million.
So I'll have what? Capital employed. Let me put it here. Closing capital employed. So I'll have 1.2 million divided
7 million.
by 7 million. What do we have? 1 2
That's
0 0 1 2 3
zero
divided
point
by,
one seven times 100, right? So we have
yes.
17.1.
Okay. So anything we have times 100 times 100. So the fact that this person, or let me just, okay, let me just change it to percentage. Okay. So the fact that this person got 17%, and I think their answer is around 20%, does not mean that the person is wrong, in as much as you have stated your assumption. So if I also want to use average capital employed, so average capital employed,
Okay.
I will have what? Let me just copy. Interesting. So I have one. It's still 1.2 million. Then the average is now average. So average is opening plus closing divided by 2. So average capital employed is equal to opening capital employed plus closing capital employed divided by 2.
That's 6 million.
That's 6 million. So divided by 2. So that's 6 million. So our this thing is 6 million. So
Yeah.
which is 6 million. 1, 2, 3, 1, 2, 3. So 6 million.
That's
So we'll have this guy changed to 6 million. 6. Just copy here and paste it here. So you have 6 million. So that's 20%. So can you see?
yeah,
So
20%.
you can use any of the two.
Okay. Okay, so it was average. Okay, that's why they had
Exactly. So
20%.
you can also use opening, but I'll just advise you stick to either average or closing. You get. So
Okay.
yeah. But if you want to collect all the mark, you can do the three. But I'm sure that in the exam hall you not.
Oh, okay. So if you are asked, okay, so you do different ones. Like
Mm-hmm.
I thought
Yes.
you were just doing one.
Yes, some people does that,
Okay.
but I don't think it's advisable because as an ICAN student in the examination hall, you are limited by time, so there's no point wasting time to do the
Fine.
three. So just state your assumption. State your assumption. That's the major thing. So let's go. So this is the return on the capital employed. So this figure now can now be compared with your average, your competitor, or similar companies, you get, to see if your company is actually doing well or not. So you know that sometimes they'll give you parameters that are not relevant to the question. For example, in this question, they gave us sales
Yes.
figure and they gave us what am I echoing? You have two devices on. They gave us sales figures and they gave
Okay.
us
Is
dividend
it?
payment,
Yeah.
but we didn't make use of it. So some people now, because they don't know the
Yeah.
formula, they will go and pick a wrong figure, you get. So you have to be careful. You have to just know your formula. They will not give you most of this formula at the back of that leaflet, so you just have to know them. So you can get a formula book where you are jotting all your formulas, so that by the time exam is
The
closed,
formulas.
you just revise them from that place. So let's go to the next one. So we have return on
Okay.
equity. Return on equity is profit after tax and preference dividend divided by share capital and reserve. And what does it measure? It measures the return on the investment that the shareholders, like what is my return as a shareholder? How much return am I getting? What it's also in percentage. What's the percentage of the return I'm getting as a shareholder if I put my funds in your company, sort of. So let's see. So we have ROCE, return on capital employed. Sorry, we've done ROCE, so we have return on equity now.
Mm, ec-
Return on equity. So return on equity, we have what? Profit after tax. Let me just copy it from here. So we have profit after tax all over share capital and reserve. It has no business with
Profit after
long
tax
term.
and preferred.
Yes, it has nothing
What
to
about
do
the
with.
preferred dividend?
That's what I'm saying. It has nothing to do with anything long term. Preference dividend is also a long term form of capital. Long term debt is also a long form of debt capital. So you have nothing to do with liabilities, sort of. So because
So,
that's how I remember my formula. Honestly, you don't need to cram it. So what what they
so
said
I
is
I did not
return.
get you escape it.
Okay, so I said you don't need to cram the formula. The parameter is
Mm,
return on equity. You already know that for you to
okay.
anything shareholders is usually after tax. Anything
Tax.
exactly. Anything shareholders is only after tax. So just know that your numerator is profit after tax. Then your denominator is everything under your equity. Everything under your equity, because it's return on equity. So everything under the equity section is what is going to be your denominator. So you don't even necessarily have to, cram the formula. So that's
So
it.
this preference dividend is just there for
Eh?
preference to the
It's not.
preference dividend.
Oh, okay. That's dividend now, not capital. I'm coming. I'm not even looking at what you're
Okay.
saying. So preference dividend. So anything shareholders, is especially ordinary shareholders. So when they say return on equity, they are talking about ordinary shareholders. So anything ordinary shareholders, if you are familiar with the definition of who ordinary shareholders are, they are the one that are left with the residual interest in the company. So if you are
Mm,
familiar with that, you know that before you can settle your shareholders, you must have settled the preference shareholders. So which then means that you must have paid tax, and must have done what? Paid preference
okay.
dividend
Preference
before
dividend.
before
Okay.
the remaining money is now left for the ordinary
Yes.
shareholder. So if you know the
Mm,
definition of who the equity shareholders are or the ordinary shareholders are, you already know what the formula is. Do you understand what I'm
mm,
saying? So
yeah.
sometimes you might forget, somebody might skip, let's not lie, you might forget formula, but once you understand the drivers, you will still find your way around it. Do you understand what I'm saying?
Yes.
Yeah, so
Yes.
it's always good to understand the formula itself. So return on equity, I think it's still the same question. Um, can you see what this is also what they said? They said profit after tax is used as the most suitable measure of return for the shareholders, since the measure of earnings is available for payment as dividend or for reinvestment. So before we can consider ordinary shareholder, we would have done everything we want to do in the company. Would have paid tax, would have paid preference dividend before we now say, okay, this remaining money is for you guys. Is either we are going to invest it, or we are going to pay as dividend to you guys. So that's the reason why we are using profit after tax and preference dividend.
It's
So the
dividend.
average value of share capital should be used. Can you see all these warnings? So we should be using what? The average value of share capital. We should not just use the share capital at the beginning or at the end. So they said we should use what? Average capital. But don't be bothered if in a question you don't have year on year, you only have the closing value. You can use the closing value. Just state your assumption. That's it. State your assumption. So average, let's now calculate the profit after tax. Okay, I think were we giving preference dividend? Yes, I think so. Dividend payment to shareholders were 225. So we're also giving the dividend that was paid. So profit after tax, but this dividend now is tricky because they didn't say that dividend to preference shareholders,
That's
right?
yeah.
So, and you don't want to assume that it is dividend to preference shareholders. So they just said dividend payments
To
to
share that.
shareholders. It could be ordinary shareholders. So I'm going to assume it is ordinary shareholders.
Why?
So, eh?
Why?
Because I feel like
Because
if it is preference shareholders, it would have been stated that preference dividend. That's the way they write it, preference dividend. So dividend payment to shareholders is obviously
ordinary
dividend that,
shareholders.
yeah, ordinary, that was paid to ordinary shareholders. So
Okay.
I'll just so you should be expecting that they'll give you that it is preference dividend and not just dividend payment to
Ordinary.
shareholders. Yeah. So um I'm assuming that preference dividend is zero. So I don't need to put any parameters or calculate anything. Let's just go straight to the denominator. So share capital plus reserve. We are using average, right? So let's do opening, then we'll do closing. Uh, mm, so average equity. Average equity. Opening plus closing divided by 2. So let's change this guy. Opening equity plus reserve. Equity. Everything is equity. Opening equity plus closing equity divided by 2. So um our opening equity plus reserve is how much? 5,000. No, not 5,000. We are removing the loans, right? So
Okay.
that will be
Yeah.
4,000. So we are just taking share capital. We are taking share capital.
Share premium and
We are
accumulated
taking
profit.
share premium.
Mm.
And we are also taking accumulated profits. So as I've said, this accumulated profit is also your retained earnings. It's also your reserve. So they will just be using different terms. So 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 we have for opening. Let me just insert. So for opening, then we have what's closing. So for opening, what do we have? We have 1 million, 1, 2, 3. Yes.
Because I think for opening is 4 million. Then closing is 5 million.
Let me just state it.
Ah,
Share premium
5 million.
500.
450 rather.
Okay, they are the same safe. So then this one is 2.5. 1, 2, 3, 1, 2, 3. Then we have 3 million. So add up. Sorry, escape. Okay, delete. What's it called? So let's go. We have these two guys. Let me just.
Minus 8.5.
Okay. So this is the opening, this is the closing, but it does not stop there. We have to divide them by 2. So that will be 4.5 equal to, we have 4.5. 4.5
That's 4.250.
plus oh sorry, 4 million safe. Opening is 4 million plus
Plus 4.5.
4.5 divided by 2.
It's yes. And 4,250,000.
Okay. So, sorry, just like to arrange my things. Okay, so we have 4,250,000.
250.
4,250,000. So that's what we are working with now. So our return on equity will be what? Profit before interest and tax.
Yes.
I be sorry, profit after tax 675. Can you see? 675,000. 1, 2, 3 divided by share capital plus reserve. We're using average. So 4,250. 1, 2, 3. Enter. So this guy should be in. I should reduce it. So bottom border. So we have what? We have
0.15.
how much?
0.15 is 15%. 15.8. So that's like 16%.
Divided by 4,250. So 15 to 16%. You can just, so it's
Yeah.
always me, but I used to put my answer in two decimal places. So it's always nice to have your answer in two decimal places. So
Okay.
yeah, just leave it to two decimal places when it comes to ratio, because sometimes when you want to compare two years, you see that they have this 15-15. Then what you kind of used to explain their difference is the decimal point at the back. Yeah.
Okay.
So it's always good to have it on two decimal places. So that's return on capital employed. Oh, sorry, return on, why am I still mentioning capital employed? That's return on what? Equity. So let's go to earnings per
So please,
share.
can you just take your screen up a bit? Let me just.
I can send this to you when I'm done, Sha.
Oh, okay, okay, okay. I'll appreciate that.
But that does not mean that you should not work it out on your own. You know, when you work
Yes.
it out, that's when it stays more. You get. So try to work it out on your own as well. Can you hear me?
Yes, I can. I can hear you.
Okay. So we have done that. Let's go to the next one, which is EPS and DPS, earnings per share and dividend per share. So don't forget that earnings per share is very important to very important to shareholders. Like when we were reading the first part of this topic, we saw a place where we said where we saw that EPS is something that they check before they can invest in your company. Is to check the viability of the company.
Mm.
Like if I invest my money in this
Come.
company, what does their EPS? What will I get per share?
Yes.
Also, DPS is also
Yeah.
important to check how much does this company pay as dividend per share. What's happening? Does it look like it's going to grow? So these are investors ratio. They are very important to the investors. So let's look at it. So the earnings per share is a measure of profit after tax. Just know that when you are talking about anything relating to shareholders, you are looking at profit after tax. That way, you won't forget your formula. You are looking at net profit. You are looking at the final profit. You are not looking at profit before interest and tax. So you are always looking at profit after tax. So, and preference dividend, if any, per equity share during the course of a financial year. The EPS might be an historical EPS as reported on the company financial statement, or a forward-looking EPS, which is EPS that the company expects to achieve in the future, usually in the next financial year. So DPS may be important for shareholders who are seeking income from shares rather than capital growth. Don't forget that we mentioned that there are two ways to maximize the wealth of the shareholders. It's either through what? Dividend growth or capital growth. So dividend payments or capital growth. So it's either you are giving me dividend or my capital is increasing. If you are not paying me dividend, you have to make sure that my capital is increasing. So now let's look at the formula. So we'll still meet up with dividend policy and all of that. So the company will have a dividend policy. There are different type of dividend policy. We have, I think, but two major school of thought. We have the relevance and irrelevance theory by M&M. So those two theories, they're just looking at, okay, should we pay dividend now or we should not pay? Does it matter if we pay dividend or we do not pay dividend? So it's another topic on its own. So we'll get there. So let's look at the basic formula for EPS. The basic formula is net profit attributable to ordinary shareholders during a period divided by weighted average number of shares in issue during that period. So this is the formula. Can I copy? I don't think so. Let me try. Okay. So EPS, which is what? Earnings per share. Let me just write it in full. Earnings per share, open bracket, EPS. So sorry. Okay, so this is the formula and we have a question. Maybe I should just, okay, let's take it one by one. Don't let us rush. Okay, EPS. So still the same question that we have been using.
Question.
Yeah. So let's look at it. So our net profit attributable to ordinary shareholders is still 675,000.
Question.
So our weighted average what?
Average number of shares in issue during the period.
So what do you think the answer is? So to get your number of shares, you'll be dividing total number of shares divided by how much, divided by share per unit,
That's it.
share
Share
price
per
per unit.
okay.
So it's still 1 million.
Okay, yeah.
Yeah,
That's
in this
1 million divided
question.
by 1.
But when we get
Yeah.
to IS 33 earnings per share, there's more to weighted average number of shares. So when we get there, but for the sake of this course, it's still 1 million. So 1, 2, 3. Still 1 million. So let's divide them. What do we have? And your answer should always be in kobo. Do you understand? So what?
Okay.
Yeah. So your answer should always be in kobo. So what do we have? What do you have on your calculator?
675. That's 0.675.
Okay, what would be the answer in kobo? That's in naira now. Anything 0 points.
Ah,
You have to be careful. Although you might be lucky, they will still give you, but it's always just good to put the answer. It's usually written in kobo, your EPS and your DPS. So what do you have? If I want to convert this guy to kobo now, that means I'll do what? Multiply by 100.
you multiple.
Yeah, because I want
I
to
thought you
make.
were going to. I thought you were going to divide.
No,
Abi?
if you are converting from a, how do I put the English now? We are converting from a bigger metric to a smaller metric. You multiply by 100 because you want to make it more plenty. If you are converting from a smaller metric to a bigger metric, you want to decrease the quantity, right? So you are going to
Okay.
multiply. So that's just the trick. So you have 67 points. Kobo. It's kobo.
0.57.
So that's the dividend. I'm sorry, EPS per share. Equal to 700. So now let's go to DPS. So it's still the same question. It's not as if they give us another question. So for our DPS, our formula will be what? Dividend divided by number of shares. Dividend paid or dividend payable divided by number of shares. Depend on the question. Share dividend, share total dividend. So DPS, so we have total dividend divided by what? Number of ordinary shares. So
Okay.
because some questions too you might have preference. So number of ordinary shares. So what do we have? Our total dividend paid is 225,000. Then our what number of ordinary shares we've already calculated it 1 million. So copy. So 1 million. So
0.225.
what do we have? We have 225
Zero
divided
point
by
two two five.
1 million. 0.225. So what would be your answer
So
in
that's 22. But you say it should always be cup. Is it 20?
yes,
Is it really not 22 kobo
22.5
or
kobo.
23, 25 kobo?
So this is our answer. So this is our answer. This is our dividend. So let's go. So we can go to the next measure, if any. Okay. So changes in price and dividend. Financial performance can also be measured by the return provided by the shareholders over a period of time, such as a financial year. The total return consists of dividend payment plus increase in the share price during the period, or fall or minus fall in the share price during the period. This total return is often called total shareholder return and can be expressed in form of percentage of the value of the shares at the beginning of the period. So let me just explain the English here. Remember that we said that the total maximization of shareholders' wealth is dividend payment plus increase in share price. But at least they are expecting any one of them. But during a period of time, like for example a year, there is no how share price will remain constant. There will be changes in the share price. So this total shareholders return is looking at that changes, compare at the end of the year, the changes in the share price at the end of the year compared to what it was at the beginning. So if there's an increase in the share price, you add it. If there's a decrease, you minus it. So the formula is price at the end minus price at the start plus dividend that was paid divided by price at the start. So it's as a basis of what happened at the beginning of the year. Do you understand?
Okay.
So the total shareholder return is everything that is my gain as a shareholder I want to see what happened at the beginning of the year compared to what happened at the end of the year, right?
End of
I mean,
year.
what is happening at the end of the year in comparison to what happened as at the
As
beginning. I
happened.
want to see if there's growth in my dividend. I'm sorry, I want to see if there's a growth in my investment with your
Share.
company. Yeah, with my shares. So this is the formula. Price at the end. Can you see? Price at the end minus price at so I'm just trying to explain to you. So it's like your changes in demand, remember? So
Uh,
so you're just trying to compare what happened, old minus new divided by old. The only difference here is plus dividend. Do you understand?
yeah.
Yeah. So so it's called TSR for short. So let's look at it. So they gave us an example. Let me copy the formula first. They gave us an example. Do you want to read the example for us?
Okay.
Price at the end.
Total sales return. Example. On 1st January 2025, share price of ABC Limited was 15 naira per share. During the year, dividends of 75 kobo per share were paid, and on 21st December 2025, the share price was 17.25 naira per share. Required, calculate the total shareholders' return.
Okay. So they've given us price as at January 1. That's the beginning. Then they gave us the dividend that they paid as at the end of the year, and they give us the share price as at that period too. So let's solve it. So price at end. Price at end is 17.25.
In 25
Price at start.
was
Price
50.
at,
Abi?
yeah, price at start. So that's 15. 15.
15 naira.
Then let's look for the difference first. So equal to, they said something that I want to call your attention to. They said, okay, when we get there, let me add this one first. This minus this.
So what were you saying? You said if the price at the end,
Uh-huh.
if it's lower than if the price at the end, sorry, is higher than the price at the start, we will add it. Or is that what
That's what
you?
I wanted to call your attention to. So if the price at the start, where is it? 15 naira. If the
15
price
naira
at the
is
start,
higher.
hmm,
Is that, yeah.
there's an increase in price. So maybe price was 10, just like this example, price at start 15,
Yeah,
price at end,
yeah,
you add the
there was an
dividend.
increase in price.
So if there's an increase in price, add what? Dividend.
You
But if
add or you
there's,
subtract.
oh, is it subtract? Is add now. The total share return of minus, yeah, is add. So if there's an increase, the total return consists of dividend payment plus increase in share price or minus fall. Where were we reading that thing? This is the place now. So they said financial performance can also be measured by the return provided to shareholders over a period of time, such as the financial year. The total return consists of dividend payments plus increase in share price. Okay, so we have mixed it up. So let's cut it like this. We'll say if
Yeah, no,
there
that's
is
clear.
no, it's still correct. I just want to rearrange it. So if
Yeah.
there is increase, and now still the same thing. You add the increase if there is an increase. It has nothing to do with dividend. So if you add the increase to the dividend, that's the word. So add increase to dividend, right? Then less decrease from dividend.
So
Do you
it has
understand?
nothing to do with the price of the dividend.
Exactly. It has nothing to do with the price of dividend. But if, for example, now
So
in this place there's an increase, that means this 2.25 will be added to dividend. But if this was 15
okay,
and this was 17.25, it will be what?
this 2.25 will be subtracted
Eh,
from
exactly.
it will be subtracted from the
From
15.
the dividend.
And
From the
that
dividend.
you are using this, yeah, you are using this as an example now.
Yes.
So we are just switching this. If this price at the end was to be the price at
At
the
the
start,
beginning.
and
Let's
if the
say this
start,
guy was 15 and this was
yes,
17. So it means that
17,
whatever we have here will now be decreased or
so from
subtracted
15,
from,
are
no,
we subtracting from the 15 or from the
from
17
the
itself?
dividend. From the dividend. That's what I'm saying. It has nothing to do with that one. From it will be added to the
Oh,
dividend or subtract. It is the
okay, okay,
dividend you are working with.
okay,
Do you
okay, okay, okay.
understand?
Now I
Add,
understand. Yeah.
increase, less decrease. So now we have, if you check what happened at the end and at the beginning, there's an increase. We are adding it to our
Mm.
dividend. So this formula will now apply. We will now say 2.25 plus, what's our dividend? 75 kobo. So that's 0.75 in naira, right?
Okay.
So everything that we get divided by what at the start. That's the formula now.
Mm-hmm.
Divided by share price at the start, which is what, 15.
So, okay,
So
okay, 50.
what's our answer?
What's our answer?
So we have
So we have
0.2, and they said
0.2.
it is expressed in what percentage? So we have 20%.
Okay.
Okay, so let's move. So so they now went further to say that this formula we are seeing can still be further broken down into capital gain and dividend yield. So to calculate capital gain yield, capital gain relates to the changes in share price. You know, right? You know, we've explained capital gain before. It relates to increase or decrease in the value of the share price. Why dividend yield relates to dividend. So everything you are doing, everything you are doing, you have a question? Okay. So everything you are doing, your capital gain yield,
Please.
what do you say?
No, I say sorry.
No problem. So
Okay.
capital gain yield relate to the share price. Why dividend yield relate to dividend? So you are still using the same formula. The only difference is just that you will not add dividend here. So let me copy. So why for, no, let's calculate this first before we move to the next one. So price at the end is what? 17.25. Price at the beginning
Okay.
is 15. So it's just equal
15.
to, yeah, 17.25 divided by, sorry, minus 15 all over what?
Okay, divided by price at the start.
Yes, at the
What
start.
do I have?
Old minus new over old. So divided by price at the start. 15. So if I copy this guy and say equal to, oh God. So we have